Maverick traders, welcome out to your currency midweek update for March 1st. Hard to believe that a couple of months are already gone. It never ceases to amaze how quickly time goes. So let's get into it this week. For this week's review, a few different things that are kind of interesting. The markets, I expected a bounce out of the equity markets, and they have not done so. So I got that wrong in essence. I thought we would have a short-term bounce. Ultimately, I'm bearish, right? We've talked about how the expectation is that we trade lower, that we go down there and test some of those lows, maybe even make a new low over the past 52 weeks and such. I still think the bear market persists, but I was expecting a bounce. We had multiple reasons to kind of anticipate that. We were creating a little bit of a Bollinger Band buy setup, and instead, all the market has done is just gravitate sideways. In fact, if you look at I think it's the last 5 trading sessions at the 50-period moving average, we've been above it, then the next day below, then back above, then below, and now we're trying to get back above today, and it's just whipsaw. It's just ugly back and forth. We really haven't gone anywhere. We've just spun our wheels. The US dollar has been stronger. It's pushed above the 104 level. However, pulling back a little bit the last 2 days, and something that's a little bit noteworthy, we'll see if it truly has legs. I think it can. I think it probably will, is the commodity push. We're starting to see a real reversal in precious metals, in commodities. The last few days, materials have been trading really strongly. So I think that makes sense ultimately, in terms of some of what's going to transpire here in the near term. I think the Fed has to keep rates higher for longer. I think we're going to see a little bit of a push into some commodities, because ultimately you have to kind of look at things on a relative basis, and interest rates are really high, which kind of hurt commodities. Not only business risk, if you're a commodity company, higher interest rates means it's more expense for you to borrow money, but also it's a comparison game. If we think about a shiny metal like gold, it doesn't produce anything. It's just it's not, there's no cash flow, right? There's no business. There's no generating of profitability. It's just a shiny metal. That's all gold and silver are. Now, of course, there's mining companies that are in the business side, but gold and silver themselves, how do they go up in value? Well, it's pure speculation. It's pure buying demand. And interest rates have really skyrocketed, which hurts, because do I take a shiny metal or do I get 5%? The only reason to be in the shiny metal when you can get 5% risk free is if you believe the shiny metal is going up 10, 15, 20%. And I think the market's rotating that way, where what I ultimately think is that we're going to see interest rates in terms of Fed funds stay high, but rates also trade freely in the markets. And I think that's where rates have topped out. I don't suspect personally that rates are going much higher from here. I'm in the rates are going down camp, meaning that a 2-year treasury that's yielding 5 point something percent, I don't believe it's about to stay there long term, or even go up to 6 and 7%. I think that the 2-year rates have kind of hit their peak, and we should see them back up to 4% and 3% and so forth. Now, if you think that those rates are going to back up, there's multiple reasons for that. Number one is buying of them. If people go risk off, they may say to themselves, well, I think it makes sense to sell stocks because they're risky and because we're going to go into an economic slowdown. I think it makes sense to buy 2-year paper that's paying me 5%. The only reason to stay in a stock is because you think it's going to return well in excess of 5%, right? We have to do a comparison. We say, well, I can get 5% risk-free in a U.S. government bond. Do I sit in stocks? Well, only if I think stocks are going to return 10, 15, 20%, right? If I think stocks are going to return flat or even negative, then I'm going to rotate out. And this is ultimately where I think the market's going towards. How quickly it goes towards this is debatable, but I think it's a sell stock, buy bond, kind of go out of risk, go into safe haven. Now, when people buy bonds, the bond price goes up, but the yields go down. So I think this is attractive enough that people are going to start coming to buy these bonds, and that will drive their yields lower, if that makes sense. Something that the Fed was doing, right? The Fed was buying bonds to push interest rates down. Now I think it's just an attractive enough yield in that short term bond asset that there should be some rotation into it, driving those rates lower. And it's all interconnected. If the picture I'm painting plays out as I anticipate, in the coming months, you'll see stocks going this way. You'll see the bond price go this way. You'll see the yield, which is always inverse, going this way. And with these yields going lower, the attractiveness, as yields back up to 4 and 3, now all of a sudden people say, you know what? Owning precious metals might sound attractive to me because these yields are coming down. Well, you know what? Maybe I'll own some gold. I'll own some silver. And so this is all a rotation that I think is kind of risk off. You get out of stocks, you get into bonds, you get into safe haven assets like gold and so forth. So gold should do okay. Oil even can do okay. Now, oil is more dependent upon the economy. So if you believe that the economy is going to go crashing to the downside, then I don't think oil does so well. But in this environment, I'm more of the camp that what we have is what I would call a rolling recession. And I didn't come up with that. I don't remember who did uh, originally, but it's something that happens in economics, which is basically a recession is a general slowdown, negative returns, right? GDP, where instead of growth, you basically have a contraction, you have a declining economy. A rolling recession is one where it hits different parts of the economy at different times. It hits this, but this is still doing okay. And then it hits this with kind of economic recession, and now this is still doing okay. And then it kind of comes over and it hits this, and now this is back to doing okay. So the economy is kind of chugging along, but at different points in time, it hits different parts of the economy, if that makes sense. And I ultimately think that's where we're at. If you were to look at it, it's a broad dispersion of what's doing okay at any moment and what's slowing down, right? We've seen that transpire already. As last year certain things slowed down, and this year other things are slowing down. We saw oil prices sharply higher at various times last year, while other parts of the economy were in a deep slowdown and getting hammered. And so I think that's kind of what's already transpiring in terms of this rolling recession. So you can't kind of paint it with a broad brush and say the entire economy is just in this recession. It's more like, well, this is where it's gravitating towards. This is where it's, kind of hurting different people. The consumer had enough cash that they were okay for a lot of last year. However, there were other parts, there were other things that were not so okay. And you had, deeper deteriorations and whatnot. So, and kind of looking at it where with rates, the Fed sets rates, what they call the Fed funds rates, but then there's rates that trade in the market itself. And right now, there's already, the yield curve is inverted. There's already some things that have been happening for a year or so, even as the economy keeps chugging along. So anyway, I hope that makes sense, that that's kind of how I would think this works, is it's a rotational thing where different things are getting hit at different times. Like for right now, we got a housing number that came out this morning that showed a deep slowdown in home buying. And that's something that's probably with the affordability of housing. Housing's held up relatively well, even though rates have gone up and even though other things are signaling a bear market. Now I think housing is probably going in towards its recession for a while. In Australia, the CPI came into 7.4% versus 8.1. Now that's good in that it's a lower than expected inflation number. Lower than expected inflation could mean that the RBA is not as concerned about inflation, maybe doesn't have to raise rates as aggressively, maybe stops, slows down, those sorts of questions come into play. In the US, ISM manufacturing PMI came in lighter than expected. And remember that anything sub 50 on a PMI is basically a recessionary number. It means that you're not growing. Sub 50 on the number is a general slowdown. Above 50 means that you're growing. In the manufacturing numbers, so there's a services PMI that comes out on Friday. It's expected to come in above 50, but on the manufacturing side, you could argue that we're maybe already in a recession. And that's what I mean by a rolling recession. Services still strong, manufacturing very weak. It's just dispersed at different times in different places. As we look at this week, so S&P flat, international stocks a little bit better, crypto, gold, oil all up, with gold being the best performer at plus 1.55% for the week. Let's take a look at a few different things here. So the S&P, I mentioned this, call it what it is. I thought if you rewind back a week ago, we were right here in this candle. And we were hitting the lower Bollinger Band. You kind of have Bollinger Bands that come in here. And I thought we would bounce. We tried to for one day. We pivoted upward. And what happened? Well, see, above the 50, below the 50. Above the 50, below the 50. And now we're trying to get back above it today as we speak. But this is going to put in 2 consecutive days below the 50. And let's just say it for what it is. When you fail to hold here, that's not a good sign for the markets. Now, so far, it's just been choppiness. But if you can't bounce after this pullback and you can't hold these key levels, that is not a signal of strength. That is not a sign of good things within the market. So I don't know. I don't have strong conviction in the short term. I ultimately thought that the market, it would be a great bearish setup if we had a mild bounce. I didn't think we would go back and, break to new highs, but I wanted to see a bounce that I could short into at a lower high. And as you set that lower high, it would just be an excellent risk to reward towards getting more bearish. Maybe it will, maybe it won't. I'm not quite sure on that, but let me call it what it is. Again, a failed level here that would have, could have, should have bounced. And I thought it would, so count me in the camp that got this one wrong. We did not bounce in the S&P. As we look at the currency world, the Kiwi strong at plus 1.2. CAD a little weaker, US dollar a little weaker. Like we talked about, there's a little bit of a burst the last 2 days in commodities. So, that's okay in terms of commodities bouncing. Maybe you get a little bit of an equity bounce for a period of time. Maybe it's just delayed and it's just choppy and frustrating the masses before we bounce for a few days. Maybe, but again, not a great sign. And certainly the market, let me say this, that the market is setting up for still lower prices. Whether we bounce or not, it's still setting itself up, I think, for lower prices in equities and more of a risk-off environment overall. So it almost doesn't matter, although it would be a nice risk to reward towards shorting on after a bounce and after we kind of set a lower swing high. In the crypto world, Bitcoin Cash, a little weaker at minus 1.6. Everything else stronger. Litecoin, because it has higher beta, more volatility, a little bit stronger performance there at plus 2.56. So as we look at the markets, What do you make of it? If we look at the slope, we almost have to downgrade this to yellow and say it's neutral. We're now downgrading this to red because we're below the 50, and we've already downgraded this to red. So, in terms of expectations, we really have to move this from last week where things were, I guess this was red already, this was still green, and this was still green. Here, now we got to be moving this way. And so next time you see it, it's just going to be over here because this is red. Let me change the color here. This will be red. That green's not showing up very well. Let me do it this way. This will be red, this will be red, and this will be yellow, neutral. So that's more, we're just moving that way. And, you know, in terms of the markets and expectations, even if we bounce and get it back above the 50, it's just not bullish. That 20 sloping down, you'd kind of run into it as resistance. The price action is rolling over. Not a great look for the markets overall. International stocks, a little bit better, but still the same problem. Tried to bounce, failed, got back above, back below, now trying to get back above. Maybe we bounce, maybe we just consolidate here for a while, but either way, it looks like the path of least resistance will still be to the downside regardless. Crypto, stronger than equities, stronger than a lot of other assets right now. It was left for dead, and isn't it interesting that the bottom here over the last few months was on the most horrific kind of news. That's kind of how markets work. They pushed those final sellers into selling whatever they were willing to sell, and that was on the SBF, the Sam Bankman-Fried fraud, and the collapse of various cryptocurrencies and so on, actually set the low because it's all supply and demand related. If more demand, more buyers than sellers exist, you'll rally up. So on that news, we collapsed for a couple of days, and anyone that was willing to sell basically sold into that bad news, that event, and from there, there's just been a lack of sellers. Maybe there hasn't been so much aggressive buying, but there's been a lack of sellers, and it set the lows. So we're still hanging in there. Surprising to me, I'm not surprised that it's had a good size rally. I'm surprised it's still the strongest asset and hanging in better than other things, but it is doing that. It's acted better than gold and silver and some of those other assets. For the rest of this week, we've got the RBNZ governor speaking tomorrow. We've got ISM services, and like I said, it's expected to show growth. Anticipated numbers at 54.5, which is still a fine growth number. Anything sub 50, again, the manufacturing PMI is already contracting, already slowing, already in basically a recession that way. So let's come over and look at a few stocks together. Look at a few currencies together. So let's come in here. Should have had this ready. All right, let's come in and look at a few currencies here together. So I'm going to turn to the daily chart, and if we go through the baskets, just look at our currency baskets of what's trading and how's it trading. Here's the US dollar, like we talked about. It kind of pierced the one. Well, maybe what we'll do is pull up the dollar index. That would be even better rather than just speak to it, because somebody might not have been here last week. So here's that key 104 level. That 104 level goes back many, many years. So here you can see it. 104. Drag your line, something like that, and you can see how we've pushed above it. So on the dollar index, we're above 104. Currently, we're pulling back, right? So we cleared 104, and now we're in pullback mode. And if you were looking at 104 as it relates to this chart, just a little bit below here. as it kind of pulls back, can use that as support. And it's actually more like that probably, where that would equate to 104 on the dollar index. This basket is a little bit different construction because it's equally weighted versus the euro and the pound and the Aussie and the CAD and the Kiwi. But ultimately, kind of in choppy mode. The Japanese yen continues to decline. I'm not super inclined to trade it to the downside because you're just one whisper, one news event away. But if you're just looking at it technically, the yen is still a short. Euro breaking out to new levels. Now, if we back this chart out a little ways, it should have some momentum and some run on this breakout. You don't have a lot of overhead resistance. You don't have a lot of things back here to worry about, and it's making a new high. This is usually when breakouts should have power and momentum. So euro looks solid, looks very good for a trade. Swiss franc remains within its channel. British pound, again, kind of choppy, pulling back the last 2 days. CAD cleared some levels, but ultimately just choppy. I think you can basically remove those old drawings and kind of say, okay, we're creating a new level of resistance up here that we'll see how it reacts to that. But right now, just still below that channel. Australian dollar, the weakest of the bunch, and like we talked about, the Kiwi, more of the stronger in the currency land. So as I was looking for trades, I mean, the last day basically, I'm looking at euro longs. I'm okay with a short or a long euro USD type of look. However, not my favorite, but we'll go through a couple of things. The daily chart is still in a little bit more of a bearish camp. So I can't, this is my rule, I can't trade the 12-hour bullish if the next longer time frame is bearish. So I got to go look at the 12-hour chart. And the 12-hour chart, to me, again, still bearish, still lower sloping moving averages, so I can't trade the 4-hour chart bullish. Is the 4-hour chart? Well, now I finally get to something that's maybe at least attempting something that's a little bit more bullish, right? We've cleared above the moving averages on the 4-hour. I can see that the moving averages are starting to reverse and turn upward on the 4-hour. So if I wanted to trade, the 4-hour is turning a little bit more bullish. You could still argue maybe neutral, but a little more bullish. That gives me clearance. The next longer time frame is now finally bullish. I could maybe trade the 1-hour and buy the dip. I can't trade it on a longer time frame because those are still bearish. Now, preferably, this would be a bullish, this would be bullish, this would be bullish, and that would be bullish. You know, that would be ideal, but I have to trade. I can trade this bullish if the next longer time frame is. So about the only chart time frame that I can trade would be the 1-hour, or maybe the 15-minute or something. I've got to take it shorter term, not longer term, because it just doesn't have that. Now, if I look at the euro versus some others, if I was buying the euro versus the yen, well, all of those time frames are bullish. Or if I was trading the euro, let's look at it versus the Kiwi's not my favorite because Kiwi's pretty strong, but euro versus pound is kind of breaking higher. Euro versus CAD is breaking higher. Euro versus Aussie has already been to the upside. So the point being, the euro looks better versus most of those other currencies. I would rather take one of those trades rather than messing with the US dollar. So take something like Euro Aussie. The daily chart's more bullish. I could trade the 12-hour bullish if it sets up. That's bullish, so I could take a 4-hour chart setup. That's bullish, so I could take a 1-hour chart setup. And if I was looking at it from the standpoint of a potential trade, you maybe have a little cup and handle forming here. Do you see that? Where it's just a resistance that gets retested And then the handle, remember, is about 30% of the size of the cup, which is 100%, right? The cup is the full size. The handle should be about 30% of the size of that. So if we look at this Euro Aussie on the long side and buying this dip, I don't hate it personally, and I'll tell you why. The low end versus the high end. So the high end of the range is 158. The low end, the bottom of this cup, is about 156. Call it 65. Is that right? 156. Let's even call it 70. 156.70. So if we do the math, how big is the cup? Well, we'll do it together. 158 is the resistance, 158 the figure, minus the bottom of the cup, 156.70. The cup is 130 pips. The handle should be about 30% of the size of that. So if I just multiply the cup size times point, I should have done 30. Okay, 0.0130 pips times 0.3. The handle should be about 39, 40-ish pips. So from 158, you should go down about 40 pips, or to about 157.60. Look at where we're at here. Right around that 157.60. If I clear the drawings, 157.60 is, I guess it didn't quite touch that, but close enough. Remember, it's 30% is a basic, idea of how big where you can buy the handle. Is it about 30% of the size of the cup? Well, that's basically meeting those metrics. And it's not an exact science. It doesn't mean that it'll come down and touch that pip number perfectly or whatever. But you see it? You see the setup? You see the idea? I would be a buyer right here of Euro Aussie. Stop loss can be pretty tight in here where you're not risking much. And then you're basically playing this not only to go back up to that level, but ultimately break out. And when it breaks out, even if it's just kind of an attempted breakout, that's where I like to at least take off half of the trade. You might say, well, why not just keep playing it for the breakout and further and further? Well, a lot of these breakouts will kind of fade off or not be as powerful as you think, kind of chop around, whatever. So we can kind of use this, buy the dip, play when people are piling in on momentum. That's often the time to at least lock in some of the profits. And then if it's a great breakout, fantastic. I'll exit the other half somewhere up here. If it doesn't have a ton of momentum, well, at least I got half of it off at a great price. So anyway, low risk, high reward type of setup. To me, that's the area that I would be hunting. It's as simple as kind of looking at what currencies have the best setup overall, which I would say Euro on the bullish side seems to be fitting the bill. And then maybe digging down into the Euro pairs to say, well, where do we want to look at? I've got Euro is bullish. I've got Aussie with a lot of bearish momentum. This fits fine with my kind of big picture approach, thinking risk off, because Aussie would theoretically sell off harder and faster than the Euro. Aussie is weaker. The fundamentals maybe back that up. Remember that the CPI number out of Australia came in weaker than expected. So fundamentally, that would lead towards lower interest rates or a slower move by the RBA, et cetera, et cetera. So things that maybe need to be priced in still support a more bearish Australian dollar move. So anyway, you've got kind of the fundamentals, the technicals, a chart setup, a risk to reward. That's what you're looking for in trading, is just checking multiple boxes, multiple reasons that all point towards the same thing. and they all kind of point towards Euro Aussie trading up in the near term. So that's my favorite idea at the moment. Good question. Outlook for gold. So in order to look at gold, we can use GLD, and maybe the best way, since I have a long-term chart already up right here, maybe we'll just click over to it. And let me zoom into this chart. Maybe we'll make it really fun here and just zoom in and make it larger. But here's basically the big long-term pattern for gold. It came up and it hit its highs in all the way back in 2011. And that's a long time ago. Then it spiraled, right? It just collapsed and eventually came all the way down here to 1,000 an ounce. So almost got cut in half. It spent the last number of years recovering, was back up retesting those highs around COVID in 2020, and then it's fallen back from that level again. And do you see a similar pattern, but just much bigger as to what we just talked about with Euro Aussie? Euro Aussie kind of had that little mini cup and handle look on that short time frame. This is a long time frame. This is we're talking about almost 2 decades worth, or 12 years in. And so when we're looking at this, you can see the same dynamic though. See how the big cup here and the more shallow handle. Notice that we've set a low and that we've recently pulled back, and there's kind of symmetry in the price action. I don't know exactly how gold's going to trade, but oftentimes it will kind of, it wouldn't surprise me in essence if gold had a little bit more of a sideways, kind of let this whole pattern catch up by it pulling back further or going sideways to create this little rounding effect, and then go up again and pull back and set a higher low. And so it just creates this circular pattern, basically, this saucer. And then eventually the upside breakout. The upside breakout is probably not for, realistically, a year, 2 years, 3 years. I mean, it could take some time for this to fully play out, to get back up to that resistance. Is it more likely to break out in 2023? No, it would be more likely to be back up at those levels and breaking out maybe next year, maybe 2024, 2025, or something like that. But I do think that's the big picture for gold. The shorter term, I mean, you've fallen back quite a bit, so you could easily see some sort of, bounce and then consolidation and so on. But I think I'm still of the camp that we've got to establish kind of a higher low in here, and this little pullback is nothing in the big picture, in the grand scheme of things. So you probably do bounce immediately, but then I ultimately think gold kind of has a correction, a consolidation. It creates this saucer effect, and the way for that to happen is a little bit more down, a little bit more sideways for a while, and then establish a higher low in here. So if I were looking at it, I might say you could even Fibonacci that thing and say, okay, let's zoom in a little closer to just what's happening recently with this rally, and you might throw some Fibonacci retracements on there and expect a deeper correction. Maybe a good guess would be that we correct back down and ultimately kind of come into this 61.8% retracement. Maybe we get down into the low 160s. So a bit further before it's all said and done, and then we come up and out of it. That's what I would be thinking. Just looking at the long term, it's a lot of fits and starts. We're establishing higher major lows, but it takes time for these things to kind of play out. So I'm not crazy bullish on gold or anything like that. I do think, will it perform better than the S&P 500 and some other assets over the next year or so? I would expect so, because I think it's ultimately, again, although in the short term it probably has a little bit more weakness or whatever, I do think it's headed back towards those highs and ultimately going to break above them in the next year or two. So I'm not bearish on it by any means, but in the short term, I do think it has a little bit more choppiness, some time to work through these things. That would be my thought. So I hope that's helpful. We have on the schedule currency recap coming out tomorrow. We've got the weekend trading room. This week's a little weird. Normally, you would expect a big event right here, non-farm payrolls, wouldn't you? Which tend to come out on the first Friday of the month, but it's not. It's weird. It's not actually programmed to be the first Friday of the month. It's programmed to be something like the third Friday after the prior or whatever. I don't remember what exactly the methodology is, but because February is a shorter month, it actually lands on the 10th. And this is probably the only time you're going to see that this year. But payrolls will come out on March 10th. This is the one time this year where it will not be on the first Friday of the month. So I generally say something to the effect of expect payrolls on the first Friday of the month because 90% of the time that's true. This happens to be the 1 month where that's not true because of the shortened February. So anyway, the more you know. Have a great rest of your week. We will see you all next week. Same time, same place. Goodbye, everyone.